Once upon a time, in a faraway land called Indiana, there was a single mom waiting tables at Cracker Barrel. One day, a little fairy came and whispered in her ear, "You should become a CPA." And so she did. Then she bought a CPA firm, later bought out her partner, and then sold the firm altogether. Hi, my name is Della Kirkman, and I'm going to tell you the breakdown of those three deals. As I started my journey to become a CPA, I found a job at a small firm in my town. The setup was a little bit unique. There were actually two separate businesses operating in the same space. They were sharing overhead items like rent, utilities, office admin help, but other than that, they operated very independently of each other. I got a job with the older guy named Ralph. Doug was a slightly younger guy, but he was still a little bit older than me. Ralph had an established practice there for many years, and Doug was just going out on his own for the first time, and so he asked Ralph if he could use office space there. And so that's how that relationship got started long before I came along. But the old guy had tons of health issues, and his business was failing. He was a great guy and a great accountant, but he was missing deadlines, not getting referrals, clients were leaving, our simple IRA contributions were being made. Now, I had offered to buy his practice as soon as I walked in the door, essentially, but I had no experience and I was not even a CPA yet. A little bit down the line, he did entertain selling his practice to a bigger regional firm, but that just didn't feel like the right fit to him for his client base. So, right off the bat, you can see that he was motivated by more than just money. Doug, the owner of the other practice, was probably a little nervous at this because Ralph's sale would inevitably have a big impact on Doug's business. Someone else would control the lease on the space, someone else would control the phone number, and so on and so on. Now, Doug thought about buying Ralph's practice, but he really didn't want to buy another business. Um, he but he did want control of everything. Again, the rent, the lease, and all that type of thing, the phone number. And so he approached me with the idea of Doug buying Ralph's practice and me managing it for him as an employee. I was very honored, but I said tax season and CPA work is just too hard to do as an employee, but I would consider doing it in some type of a partner situation. Even though I had no money and not a whole lot to offer, he agreed. And so that's what we did. So again, this shows a buyer that was motivated by more than money. So together we developed Perkins and Kirkman CPAs. We made it official in January of 2012. As I said, Doug didn't really want another business, so we continued to keep the two firms very separate. Doug ran his original business, and I ran the new business, the one that we were purchasing from Ralph. It was also mentioned up front that if I ever wanted, I could buy Doug out, but nothing was ever finalized. So here is how that deal structure was actually laid out. Again, Doug was very motivated to keep his business and his life pretty much the same as it had been for the past several years. No cash came out of my pocket, and Doug did put up a little bit of money, about $10,000 for the office equipment, computers, furniture, phone systems, and the like. As far as the business itself, we agreed on purchasing it for a price of 1x annual earnings, which is fairly common for a service-based business of this type. Again, no money was paid up front for the purchase of the business, and we had agreed to pay him 5 years, 20% each year from 2012 to 2016. We would make monthly payments, so every month we would count up how much money was collected from his purchase client base and give him 20% of that. And then we were also very generous in paying him 20% of the referrals that came in from that original purchase client base. So Ralph, the old guy, did stay on as a part-time W-2 employee. I ran the entire Perkins and Kirkman part of the business, lots of guidance from Doug and Ralph. I got a small salary, which did cover all of my living expenses. And Doug was paid on an hourly basis for his review work, and I wrote that check to him one time at the end of the year. I also received a bonus at the end of the year through actual payroll, and this was based on the clients that I brought in. So we compute our annual profit margin at that point in time, and then multiply that by the revenue that I brought in, and that was my bonus, again, paid through payroll. Now, how much reinvestment was required in this particular type of business? It is a very seasonal business, so in the first part of the year, we were very busy and lots of money came in. and we, or essentially the business, would live on that throughout the year. And then every December, we would pretty much empty the bank account except for a small amount that we needed for working capital to get started, in the next tax season. And then we split that cash that we took out based on our 51-49% ownership split. Doug being 51 and I'm 49. So we continued to share office expenses, which becomes very relevant later on. He paid the utilities and the rent, which of course are ongoing monthly expenses. And I paid for the office supplies, the postage, and the admin help that we hired, which was only during tax season. So my part of our shared expenses were heavily weighted in the beginning part of the year during tax season. As far as our operating structure, we kept everything pretty much the same, especially client-facing items. We added in a website, newsletter, a portal, texting, things like that. So I ran our Perkins & Kirkman firm. I did all of the client interaction along with my staff. Doug, of course, was very instrumental, but he was behind the scenes in this firm because he was actively running his other firm. So Doug would come to me and say, well, this is how I handle my accounts receivable. And so I would handle the accounts receivable in pretty much the same fashion. He would say, this is how I do my billing. And so I would do the billing in the same way. And like I said, he was still running his own separate firm, and he was also reviewing all of our business tax returns because me and my main staff person had no experience in that at all. But the business immediately began to turn around. We had lots of new business, lots of referrals coming in, which was also nice because every time I wrote Ralph a check at the end of the month, he was surprised at how large it was. So it was nice that he was happy. I was having fun running the business. Doug was behind the scenes where he likes to be, so everybody was happy. And we were paying off the business entirely out of profits and never took on any debt. Now, there were challenges, of course. There was pushback on change in general. There was a little bit of pushback on a young female taking over. There was a little bit of pushback on the cute little logo I came up with. And then as Ralph's health continued to decline, that presented its own set of problems, and eventually I did have to let Ralph go. So as I said, we're chugging along, doing pretty well, paying things off, not taking on any debt. And then out of the blue, early in tax season of 2015, so this would have been about 3.5 years into the original 5-year purchase, Doug, my business partner, suddenly came to me and said he was not going to be checking any of our business returns. And among other things, I thought, well, then he's pretty much not helping me with anything at this point, so I should just buy him out and run the show on my own. So I went to him and I said, okay, well, we had mentioned up front me being able to buy you out at some point, and I think now's probably a good time, so what's it going to take? Again, we were 49, me, and him 51% shareholder in an S Corp, which is a pass-through entity. So all he really wanted was his portion of the retained earnings, because this was essentially profit that he had been taxed on but not been able to put in his pocket because of our flow-through situation. So the retained earnings at that point was only about $45,000. Again, we were putting almost all the profits towards paying off that original purchase. So he wanted this in 2 payments, payment at the end of that year, 2015, and then the second and last payment at the end of 2016, which would also coincide with the last payment from that original purchasing of the client base from Ralph. So we agreed. Everything was going along just fine. I was paying both gentlemen during that last year and a half or so. Again, not really putting any money in my pocket, but I was building this asset. It was paying for itself, and I did not have any debt. So for the next year and a half, we continued on, pretty happy. Both of our businesses were growing. And then in the summer of 2016, I heard a little rumor through the grapevine that Doug was looking for office space to move out of our shared space. And so I approached him. I said, hey, I heard you found an office space just for yourself. And we had actually been looking for something together, but it just proved extremely difficult to find something large enough to accommodate both of our growing businesses. But he confirmed that he was leaving in just a couple more weeks. And I thought that was unfortunate that he was leaving on such short notice, in my opinion. But I was comfortable that he would continue to honor our shared expense agreement that he had come up with. As it turns out, that wasn't the case. So when he left, we still had about 4 months of rent and utilities in that particular year. He did end up paying 1 more month rent, but in my feeling he broke our shared expense agreement, because by the time, this was August or so, by the time that had occurred, I had already paid all of my portion of our annual expenses up front, because all of my expenses occurred during tax season, January through April, and I had already paid for all of that, and I had expected to have my rent and utilities paid in exchange for that throughout the rest of that year. Well, at the end of that time period, it was about $4,000 I felt that he owed me, and so I took that last payment that I owed to him, shorted it by about $4,000, and wrote in that check memo, final payment paid in full. And I sent that off to him and waited and fretted just a little bit, but after a few weeks, he did end up cashing that check. And so he was paid in full with no final recourse at that point in time. So my business now here on my own with a few staff members did continue to grow. We implemented new technologies, increased our prices, focused more on community and customer service. And as things went on, again, I was able to finally put some money in the bank because everybody was paid off, and things were going really well. But then it just started to be, not quite as fun as it had been. And then this year, the pandemic came about, and all the PPP regulations, and changing that every single day, and then it just really wasn't fun anymore. So in June of this year, I did decide to sell my practice, or at least try to sell it. I really didn't know what to expect. So I did decide to use a broker. And to sum up my broker experience, it inspired me to consider starting my own brokerage firm, or buying one, because I would have been happy to do much more work than what my broker did for a lot less money. But I did list with a broker in June of this past year. I mostly used a broker for anonymity. I was terrified that my clients would find out that the business was listed for sale and leave. I was worried that my staff would find out it was for sale and leave. And this, was my bread and butter. This is how I was, still being a single mom, still had a teenager at home, and I was just really worried that wanting to sell was just going to kind of blow up the whole thing. So that's the main reason I used a broker. I really needed that anonymity. So I got lucky. There was lots of interest right away. The way it worked in this particular situation, I knew their identity, but they didn't have any idea who I was personally or what firm they were looking at until I reached out to those potential buyers and disclosed who I was. I met with several buyers, some in person and some over the phone. Some of them had tax experience and some didn't. But I got my first offer on August the 4th. Now, it wasn't a great offer, but I was pretty excited to have some action going on and something happening. Then a couple days later, I got a second offer, and this one was much better. This one was to be 70% cash up front, and the remainder paid in 2 payments over the next 2 years. Unfortunately, we got hung up on the non-compete, and in my opinion, the broker got greedy and probably ruined that deal for me. But what was really infuriating about the whole thing is that, come to find out, the buyer actually rescinded that offer on September the 4th on a Friday, and the broker didn't bother telling me that that offer was off the table until the following Tuesday. So that was kind of a long time in my opinion. But the third offer came in on September the 16th, and they were proposing a closing date of September the 30th. So we skipped a letter of intent, went straight to the purchase agreement. Her attorney wrote up the first draft, and then we tweaked it ourselves and then signed on the dotted line. We did end up closing on September the 30th. The broker did not help with the sale itself or the transition at all. He did not act as the closing agent. He wasn't at the closing. He didn't even offer generic help with the transition, which I thought, especially since he focused only on accounting, tax and accounting firms, that he would have had a lot more input on that. And then he sent me the invoice for his services prior to our closing date even. So all he really did was send postcards and collect my financial statements. But here's the deal structure for actually selling my firm here this past September. It was a deal with 90% cash up front. Remaining 10% is to be paid to me at the end of 3 years, so I'm not expecting another payment until 3 years from now. And that's a convoluted formula that she came up with, but it is based on client retention over that 3-year period. I agreed to stay on as an unpaid consultant for 1 year, and it is strictly an asset sale. She purchased my client list, phone number, fax number, office, furniture, computers, I did include what I would consider a very wimpy non-compete, so I'm not too worried about that. And then the forwarding of my website for 1 year. And the transition is still ongoing. It's not at all what I expected, but I'm super glad that I sold the business. I'm glad that I got the cash up front, and I'm happy to be able to focus more on Hardware Club activities. Thanks so much. Have a super day.